Welcome back to the Deep Dive. Today, we are taking a really deep cut into the Synopsys Q4 fiscal year 2025 earnings call.
And this one was more than just, a standard quarterly check-in.
Exactly. This was really the first full view we've gotten of a massive strategic metamorphosis. Synopsys is trying to vault past its role as, well, the king of electronic design automation.
The pure software tools.
Right, and transform into this vertically integrated engineering platform, something that spans from, the silicon chip all the way up to the entire system.
And our mission today is really to figure out if the numbers actually back up that huge strategic shift.
So do they?
Well, they offer a pretty compelling opening argument. I mean, the immediate market sentiment was constructive. The big takeaway for investors was that the results were seen as better than feared.
Which, given the stock's performance over the last year, is saying a lot.
It is. And that caution turning into optimism, it translated into a really notable pop for the stock in after-hours trading.
Okay, let's unpack this with the core numbers. The headline beat was pretty significant.
It was.
Synopsys posted non-GAAP EPS of $2.90. That sailed past the consensus range of, $2.79 to $2.82?
Yeah, by about 11 cents. That's a surprise of nearly 4%. Pretty solid.
And the revenue was just as strong. It hit $2.25 billion.
A massive 37.8% year-over-year increase. It came in, right where Wall Street was hoping, maybe even a little bit above.
But what's fascinating is where that gigantic revenue jump actually came from. It feels like it immediately validates their whole strategy.
It absolutely does. The newly acquired Ansys business, it contributed a colossal $667.7 million to that Q4 revenue.
Wow.
In just one quarter, Ansys basically established itself as a foundational pillar of the new Synopsys.
And this isn't just about one quarter, it's about visibility, right?
Yep.
The company finished the year with a record backlog of $11.4 billion. So for you listening, if you're trying to gauge stability, that backlog is a strong multi-year revenue foundation. It gives them durable certainty as they go through this very complex integration.
And if we zoom out to the full fiscal year 25, the whole thing generated $7.054 billion in revenue. That's 15% growth year over year.
And the efficiency.
The non-GAAP operating margin was really robust, clocked in around 37.3% for the full year.
I want to pause on that non-GAAP number for a second.
Yeah.
We know they just spent billions on a deal and they're restructuring. Why is non-GAAP the one to focus on here?
That's a critical question because non-GAAP gives you a clearer view of the underlying profitability of the core business.
Okay.
In a year like this, it strips out all those massive one-time charges. The Ansys integration costs, amortization, the restructuring charges we're about to talk about.
So it tells you the actual ongoing operation is still highly profitable.
Exactly. Even with all the chaos of a major transformation.
And you can see that structural chaos pretty clearly when you start dissecting the different segments.
Oh, absolutely. The design automation segment was just rocket fuel. It soared 65.2% year over year, which is, obviously heavily boosted by Ansys.
But then you have to look at the other side of the portfolio.
The painful side. The design IP segment actually declined by 21.4%.
Which wasn't a total shock to analysts, but it really signals the immediate impact of that restructuring and the tough transition for their IP business.
Right, and that IP decline makes more sense when you see the capital they're deploying.
The Nvidia investment.
Exactly. Management laid out two huge financial actions. First, that $2 billion strategic investment from Nvidia was critical. They used that cash to immediately accelerate term loan repayments from the acquisition.
And they have a plan for the rest of it.
They do. They plan to repay the remaining $2.5 billion balance in the first half of fiscal 26. It shows they're actively managing that debt load.
And that debt strategy goes hand in hand with a pretty serious efficiency drive. We're talking about a huge internal restructuring.
Yeah, cutting roughly 10% of the global workforce. That's about 2,000 employees.
Integrating a massive $35 billion company while laying off a tenth of your staff?
Mm-hmm.
That's a serious risk, even if it saves money.
It is a high-stakes move, but it shows they are dead serious about getting those cost synergies, and they were transparent about the cost.
How much is it going to run them?
The restructuring will incur pre-tax charges between $300 and $350 million. They said about $225 million of that is a cash outflow that's already baked into the fiscal 26 guidance.
And that commitment to efficiency is what leads to those really ambitious cash flow targets.
Extremely ambitious. They're targeting $2.2 billion in operating cash flow and $1.9 billion in free cash flow for next year.
Okay, let's put that in perspective. Almost $2 billion in free cash flow. That's Synopsys telling the market they can pay down the Ansys debt and still have enough dry powder left to self-fund innovation and their AI R&D.
That's the financial proof point of the whole merger.
Precisely.
Which brings us to the most crucial piece of the puzzle, the guidance for fiscal year 26. This is the number that's driving the stock's re-rating.
Okay, so they guided FY26 revenue between 9.56 and 9.66 billion. The midpoint there implies growth that includes roughly, 2.9 billion from Ansys?
That's right. And the non-GAAP EPS guidance is strong at 1432 to 1440. But you're absolutely right. The single most important metric in that entire guidance package is the implied non-GAAP operating margin.
40.5%.
40.5%.
That is highly aggressive. That's a leap of 320 basis points from where they just finished. How much of that is just cost-cutting from layoffs versus actual new high-margin revenue?
That's the million-dollar question. I'd say you have to assume about half of that comes directly from realizing the Ansys cost synergies and from that deep restructuring.
And the rest?
The rest has to come from operational leverage and monetizing those new joint solutions. The risk is that you cut so deep, you slow down the innovation engine. It's a real show-me target for the street.
To get there, they need tailwinds.
Mm-hmm.
CEO Sassine Ghazi stressed this move to an engineering solutions leader, and he pointed to where the demand is coming from.
Yeah, and it all boils down to the complexity explosion that's being fueled by AI. He noted robust demand pretty much everywhere: AI accelerators, high-performance computing, mobile, automotive.
All areas that need the kind of system-level simulation that Ansys brings to the table.
Exactly. This is the synergy narrative in action, and that Nvidia partnership acts as a crucial validator, that this isn't just, a theory.
That's spot on. The $2 billion from Nvidia wasn't just cash. It's a co-development deal for AI-powered design tools. It validates Synopsys' role in next-gen chip design.
And they highlighted some real adoption. Nearly 5,000 active users among their Tier 1 customers are already using their AI-driven tools.
So it's not just future potential.
Not at all. And we also saw a huge demand for hardware-assisted verification, or HAV. They cited 12 competitive wins in Q4 alone, just driven by the need to test these massive complex chips.
Okay, but let's talk about the weak spot, design IP. We saw that 21% decline. How does management square that with all the AI excitement?
They labeled 26 a transitional year for IP. They're expecting muted growth, which is, a soft way of saying it's going to be tough.
And why is that?
It's linked to two things: slower foundry uptake on some new process nodes, and just the internal need to reallocate resources to build out key high-performance computing titles. They're still confident in their long-term target of mid-teens growth for IP, but
they have to close those development gaps first.
By mid-year.
Okay, and we have to confront the elephant in the room. China. This feels like a fundamental risk to the whole business.
The numbers are stark. China revenue was down 18% year over year, and if you strip out the new Ansys revenue, that core decline was even sharper, at 22%.
And their guidance assumes?
It assumes no further tightening of U.S. export controls, which is a risky assumption in itself.
What's the direct consequence of the existing restrictions?
It's leading to some visible share shift to local Chinese alternatives for those really advanced tools. But the Ansys portfolio seems more resilient there.
How so?
The Ansys business serves a broader, less restricted industrial market in China. Think automotive, aerospace. That side of the business has held up much better than the advanced chip design business.
So what does this all mean for you, the investor? Synopsys is shifting from this predictable high multiple EDA pure play,
which was easy to model,
right, to a complex vertically integrated engineering giant. And that ambiguity, it caused that painful drawdown in the stock. But it feels like investors are starting to warm up to the plan.
The belief is returning. But analysts really press them on one point. Why is core EDA revenue growth slowing down when you have these massive AI tailwinds? It's a monetization problem.
And management basically acknowledged that. They said the industry can do better at capturing more value.
Right. And they laid out 3 explicit paths to get back to sustained double-digit growth. Path 1 is joint solutions.
integrating Synopsys and Ansys tools to solve things like 3D IC design.
Exactly. The first wave of those integrated solutions is expected in the first half of 26. They're moving from selling individual tools to selling combined high-value outcomes.
That's a huge shift from the traditional software license model.
It is, and path 2 is leveraging agentic AI. Think of it this way. Synopsys used to sell the recipe book, right? The software license. Now they want to sell the 5-star meal. The complex chip design their AI tools helped create and capture a piece of the restaurant's profit. They're trying to monetize based on value and impact, not just seat licenses.
That could change the entire software sector. And path 3, it addresses the struggling IP segment.
Yeah, they're in serious talks with customers to move beyond the standard model of, NRE plus a use fee.
To what?
The new model they're pursuing is NRE plus use fee, plus a royalty and upside component. It's a powerful move to capture the long-term economic value of their IP.
So to sum up the outlook, execution is everything. It all hinges on a flawless Ansys integration, hitting that aggressive 40.5% margin target, and no new surprises on the U.S. China front.
The plan is laid out. Now the real work begins.
All right. And now for the segment we call, This is not financial advice.
Please consult a qualified professional before making any investment decisions. We are simply discussing plausible outcomes based on the source material.
Okay, here we go. The outrageous but plausible trade. Given that aggressive 40.5% margin target for fiscal 26, a number that relies so heavily on integration and cost-cutting, the market is potentially underestimating the earnings leverage here.
Therefore, the trade pitch is a relative value paired trade. Long Synopsys, SNPS, short Cadence, CDNS.
The conventional wisdom is that these two move together. Why separate them now?
Because the market has historically valued them based on their pure EDA rivalry. But if Synopsys actually pulls this off, if they become a high-margin silicon-to-systems platform, it fundamentally justifies a higher valuation premium than its traditional peer.
So the bet is that hitting the 40.5% margin target proves the Ansys deal was truly transformative.
Exactly. Pushing SNPS stock to re-rate significantly higher relative to Cadence, even with the short-term IP headwinds.
A fascinating thesis. But it all hinges on management hitting an extremely ambitious target.
That's the trade.
To quickly recap the core story, this quarter was defined by a strong beat, a bold structural transformation with the Ansys deal, and a clear, albeit aggressive path towards significant margin expansion in fiscal year 26. You now have the full picture on how Synopsys plans to capitalize on the AI build-out while managing some serious geopolitical risks.
And here is a provocative thought for you to chew on. Management is actively looking for new ways to get paid, right? Royalty, IP, value-based AI solutions. If Synopsys and its peers actually succeed in cracking the traditional EDA business model, which fundamentally changes the rules for the entire software sector, how quickly will Wall Street's valuation model for these companies have to adapt, and who gets left behind?